welcome everybody. Talk about blockchain. I think that's one of the fun things today. So we'll get started. I used to ask a question of who has heard about blockchain and stopped asking it now. I'm now asking who has not heard about blockchain, and I don't get any hands. So is that true here? Yes. Okay, how many of you hold any sort of cryptocurrency assets, whatever you want to call it? How many folks have any? Nice, so that proportion is going up slightly. It went up a little more last year, but it's gone down a little. So we'll talk about a bunch of these things as we go ahead. So just to start us off, I'm Soumak Chatterjee. I'm a partner in the firm. One of my roles at Deloitte is I own overall accountability for our blockchain business in consulting. So in that role, I do a bunch of work across the world in Canada with a whole set of industries across financial services, government, et cetera, et cetera. One of these work was with the World Economic Forum in 2016. And what we decided to do with the forum was to look at blockchain as the next generation of financial market infrastructure. So my first interaction with lending and blockchain came at a large global bank, and we're talking to their trade finance operating team. Right, the folks who run trade finance back offices. And there were some startling facts that they had shared at that time, including that about $500 million of spend in a year on just postage stamps for trade financing. There is probably 5 to 6 pounds of paper that tracks any large trade between Asia and the US. So a lot of that was still very manual, very archaic at that point. And in that report, which the forum had authored in 2016, I'm completely biased, but it's a brilliant report because I wrote it. But we had touched upon a couple of these cases. We touched upon trade financing, we touched upon syndicated lending, and there are a variety of more which had shown up. And then there has been a classic growth in this assets market around tokenization, around creating new business models based around something that didn't exist. So we're going to talk about all of that, and to help do that, I have a fantastic panel here. So just doing a quick introduction, we have 55 seconds now, so I'll run through this really fast. So extreme end, Sam. Sam's co-founder, CEO of CORL. The world's first revenue sharing token designed to support the growth of emerging companies. Prior to CORL, Sam was the head of product at IOU Financial, a leading fintech SMB marketplace lender based out of Montreal. So thanks for being here. Next is Yash. Yash is from Plaza Ventures, where he has a fantastic title of being a blockchain project director in the tech venture arm of Plaza Corp. Yash is spearheading the tokenization of real estate assets. So that's something we will spend quite a bit of time today talking to Yash about. So he's a leading advisor to the ICO project that is happening in the peer-to-peer lending space. Gary is next. Gary is the CEO of MortageBlox, a mortgage investment entity focused on mezzanine lending for developers and builders. A career as an evangelist in innovation tech, solutions to solve customer problems. Gary will talk about the impact of blockchain specific to mortgages. And next to me, Diana. Diana has a very illustrious CV, and one of the many things she has done is she has spearheaded very early on due diligence on Ripple when Accenture made their investment into that venture. She was at Accenture at that point as the global lead in blockchain. She has since is the CEO now of Pegasus, fintech accelerator, and the co-chair at Silicon Valley Blockchain Society for Toronto. So thanks, all of you. What I thought we would start off is just to level set the field, let Diana kick it off with sort of kind of a 101, but quick pass at level setting the information about what is blockchain, what are we talking about with respect to DLTs, and provide a treetop of how blockchain is being looked at in the overall lending space.
Sure. So for all of you, I'm just going to go really quick about blockchain. So the way to think about it is that it is really a unique type of transactional database. And what makes this database unique is that the data that's already transaction that actually occurs on that particular database by those that are involved within that platform would have already had agreed to the legitimacy and accuracy of that transaction. And that particular database, everything is permanent. So there's no way of you'll hear this term immutable. There is trust within that particular database. So often today, and when you think about this is a platform, it is a ecosystem play, and if I'm working with Deloitte and I'm doing a transaction with them, and I have my data, Deloitte will have their data. I trust mine, he trusts his, they trust theirs, but we don't trust each other because we have a way of managing our information. On a blockchain, when we have done a particular transaction together, we will have already agreed in advance of that transaction when it shows up. So that's really kind of blockchain in a nutshell. When we think about the lending landscape, and particularly around the mortgage and property, one of the things that when I looked at this early few years back, companies were actually testing blockchain with property. And because property, the way to think about property is it's an asset, it's a physical asset, and how do you represent that asset digitally, and as it's what we call a tokenized asset that would occur onto a blockchain. And if you look at, there was different pilots that have been done. One notably was in the Honduras with a company called Factum. And basically, because at that point in time, many homeowners, they had no way of actually proving that they actually own that property. And so with their implementation and pilot, they were able to actually determine that that person indeed had ownership. And we've seen some of these other types of pilots occur even in North America, in Brooklyn, for example. So those are that's a particular use case of a digitized, a tokenized asset. And then when we think about lending, because as a property gets transferred between individuals or between entities, there's got to be some sort of paper trail. And that's where, when you think about mortgage and lending, so with that particular transaction, you've got a change of ownership. Then you have also money that's moving between the entities. And then there's information that's moving about those two types of transactions. One about the property and the second about the money aspect of it. And so the innovation, I think the way to think about this from a platform perspective is that today in a lot of these transactions, what makes them complex, there's a lot of different paperwork, there's a lot of moving parts, and that information gets lost. And if you think back about the mortgage crisis in 2008 in the secondary markets, a lot of the loans and the details behind them were actually not there. Now with blockchain, what it proposes and helps organizations like these gentlemen on my left, there is a way for that information to now be very transparent, and that everyone would have, again, you would agree to the transaction that has occurred. So kind of in a long-winded way about what's actually happening in terms of lending and assets.
Thank you, Dan. I think the one point which you mentioned which resonated is this notion of trust and having trust built through code, right? Because wherever we have done it before, we've created institutions. And we have had central structures that run that. And that is probably the most potent change of having trust built through code. Any other broad examples globally around other folks, any broad use cases in the lending space, if we take a broader look, that has come to attention from anyone?
You're starting to see more use of, for example, using your crypto assets as a collateral lending. So you still have the traditional fiat lending or US or Canadian dollars, whatever currency, but you use now, instead of personal guarantee being your current condo or other assets, you can use your crypto as a collateral. That's one aspect of it. In lending, you're seeing more the peer-to-peer concept now of lending that we're used to right now, but happening on the blockchain instead. So, or LPGP structures in lending firms also following that approach. And then we're still scratching the surface with that.
Right. Gary, anything specific from your point, like for the perspective of mortgage itself, like how is it different? Like what is changing? Is this better? Like,
yeah, well, I would answer it, I guess, in two ways. One, the way Diana answered it, which is in general, feels like blockchain to me is where digital was 15 years ago. A lot of awareness now, not a lot of usage yet. It's starting to happen now, but on the, from a MortageBlox, the company I'm associated with here today, there's two ways that we think about it. One is on how to leverage tokens as part of capital formation. I'll talk about that in a second. But all the things Diana mentioned, I think, are very exciting for the mortgage business on how blockchain can affect, because you have this distributed ledger technology, immutable proof of transactions happening, an opportunity to eliminate friction with all the different approvers and people that were involved in that process historically, now being essentially eliminated by blockchain or made much more fluid. So you've got speed of completion of transaction capability through blockchain, that defeat of fraud potentially, or reduction in fraud. So lots of very positive things, smart contracts, all of these things that are enabled by the blockchain, which I think is very exciting for lots of different spaces, including the mortgage business. So for MortageBlox, which is what you would call a quote unquote traditional commercial mortgage lender, applying some different ways of thinking about about origination and thinking about the decisioning on the lending that we do and the way that we support projects across the country and into the U.S. The way that MortageBlox thinks about the blockchain advantage is through tokens. So where we're going to leverage the blockchain technology is by issuing tokens as a way to acquire or create capital coming into the MortageBlox fund that will support these project developments that we will have in both Canada and the U.S. Those will, of course, essentially be equivalent to a preferred share. They'll be secured tokens, and they'll follow the Reg D and Reg S requirements for those tokens. But it's an exciting way of what I think of as democratizing the availability of investment into these funds by, first of all, defeating some geography barriers that may have existed in the past. With tokens, you can now attract investment from all over the world into a fund. You also have the potential of lowering the bar a little bit not on the quality of investor, but the level of investment required. So where certain opportunities like a MortageBlox would have required someone to be at a very high level of investment, blockchain drops that bar down a little bit, and you can have more investments at a smaller level. So we're excited about the token opportunities, and Pegasus is a significant partner in helping bring that for MortageBlox to market in the U.S. In 2019. And we're hopeful that that same opportunity, which doesn't exist in Canada yet, will be upon us soon.
Awesome. So I think we're starting to bifurcate into going into this token space a bit. And I think where Diana started us from is there's two distinct worlds, right? There's the world in which you're using DLT blockchain as infrastructure to drive operational benefits, right? I think it's important to make that distinction clear. There's the infrastructure part where you're trying to use it in traditional businesses in making things work better, in having single sources of truth, as Diana mentioned, between two parties who seem to have disparate trust obligations, right? So I think that's one part of the world, and there's good work happening in that world in a variety of use cases which we talked about. And then we're starting to go into this new world of tokens. So before we go too much down, Sam, would you mind just doing a little bit of token for dummies?
Yeah, for sure. Any of you here heard of initial coin offerings or participated in initial coin offerings the past 2 years? Raise your hands. Sorry, what? Initial coin offerings.
Let's explain that.
So yeah, I just wanted to kind of see what information to drop here. All right, so initially, if you look at the crypto world, we're starting to hear, you have Bitcoin, you have Ethereum, but now you're seeing projects that are popping up in the space with their own token. And that token basically could represent different things in each project. For the past 2 years, things have been packaged at what we call as a utility token. Let's take it a step back and say, define what a utility token is and what the other aspect of the spectrum is security token. Let's start with the easy one. Security token is anything that's backed by financial assets, right? Real estate, equity, debt. Utility token is everything that is not a security token. The past 2 years, every project on the market has packaged themselves as a utility token, meaning it's being used for the project itself as a membership or a way for you to access the platform. ICC came cracking last year and this year saying, well, everything in the market has been a security token plus issue subpoenas. So the tokenization aspect became a new way for projects, one, to create that followers around them, because now you have the crypto community purchasing those tokens, buying into your project. And it's also, for some, it was a quick way of making a buck and raising money because they can raise money in the traditional way. We're starting to see a shift in that paradigm where security tokens, which Gary was just talking about, what CORL also is doing in that security token space, that's where the industry is starting to move, right? People are starting to move away from a utility token, which represents nothing, where you go to bed, it's $10, you wake up the next day, it's either 0 or like 1,000. We're moving towards the industry using security tokens as a norm, where that token could be a real estate project, an equity, or a debt facility, right? And that's where the concept of tokenization started originally, and that's where it keeps growing. If you've heard about ICOs or initial coin offerings the past few years, one terminology you're going to start hearing now, and it's going to keep growing, is security token offerings, and that's where each token represents an actual security in the project. Real estate is a great example, tokenizing the real estate fund or tokenizing the asset itself, or even, for example, what CORL is doing, we're doing a decentralized IPO. So our token represents equity in our company, and we're effectively going public. But instead of your traditional share that you'll see on the NASDAQ, TSX, or CSE, you'll have a token that will trade on those exchanges down the road. That provides you more self-sovereignty of your financial assets. It's not only with CompuShare and CDX, it's everyone owns their own share, manage their own tokens. And that's kind of creating that democratization of investments through that, right? So that barrier of having ultra high net worth individuals only participate in a real estate fund or a royalty fund, it's opening up for to day-to-day investors, wealthy investors. Pretty much anyone can come in on a project with their capabilities. One, to support the project, and two, also get that return that everyone else is getting.
Yeah, so Sam, just to break it down a little bit then, so in your words, so a token is essentially, if I understood it correctly, a digital representation of something. In some cases, it is backed by real world financial assets, exactly, which is your security tokens. And if it's not, it's this notion of these things have utility somewhere. Right? I heard one person mention this, and it kind of stuck in my brain. It's like somebody is building a fairground. And they're saying that when it's going to be built like on Lakeshore, it's going to be the best fairground on the earth, and we're going to charge $50. You can buy these tickets now, and we'll sell it for like 10 cents, and you give me 10 cents now because I'm going to build it for you later. And then hopefully, as the day progresses, you might also have a secondary market to trade these things on. Like that's one of the ways people have categorized this. So like let's go to real estate a little bit, Yash. Like you have been in this space about tokenizing real estate assets specifically, correct, and starting to look at how to create ecosystems around this and to just do what Sam just mentioned on it. Would you just shed a bit of light on that?
Yeah. So I mean, real estate and lending. We know real estate is one of the largest industry for lending, between mortgages, residential, commercial, construction financing. There's a huge impact. And we also know that it's a very inefficient industry. There's a lot of paperwork, there's a lot of middlemen, there's a lot of process, and it's ripe for improvements through technology. And some of that doesn't have to be blockchain, but we believe blockchain is a prime use case for this case. Blockchain provides security, transparency, efficiencies that'll benefit greatly. So let's take, for example, the idea of a condo buyer, right? Today's Gen Z, millennial, they're trying to get into the real estate market, and seeing the way the prices are, it's just like unaffordable for them, right? Now, so if you were to take a traditional real estate portfolio and tokenize it, it gives an opportunity to an investor to fractionally invest, right? Come in at a much smaller dollar amount, right? So it opens it up to a much broader audience. Not only access, but also the efficiency gained by tokenizing it, and blockchain platform will enable a lot of kind of streamlined benefits of it. So just the cost of ownership becomes lower. And then down the road, a lot of these REIT portfolios or different forms of real estate investing have a lockup period of like 2, 3, 5 years, right? And they need to have that because there's no secondary market for it, right? Once you have a token, specifically a security token that can be listed on an exchange, it opens up a whole liquidity pool and access, and creates a much more friendlier environment for the whole process beginning to end. So specifically security token, we're very bullish on it, and we feel that it has an opportunity to kind of affect not just the investment, but even the lending part of it. Now, imagine if you have a token, how can you use that even in lending? How can you use that as collateral? How can you use that, to make it a much more efficient process?
I think, what tokenization is just not providing that liquidity and efficiency. It's also, I think, from a compliance point of view, it makes the auditor's job way easier. So, like from a Deloitte's point perspective, for example, right? Imagine you want to have to audit all the transactions that happen. Now you have a ledger online, you have the blockchain there. You can simply just look at that smart contract, see what's in, what's out, if dividends were paid out, who can contribute it. All of that makes that process faster, and at the end of the day, that translates to cheaper costs to the business and everyone else. And the liquidity factor, I think, is a huge aspect, right? Mm-hmm. Venture capital is one of those best examples where you have that lockup up to 10 years. LPs are stuck for 10 years, for example. But now, for example, if you tokenize a venture capital fund, LPs can come in and out, and LPs now are not just limited to people who are making $1 million or $2 million a year. Someone can go in a VC fund, for example, with $100. That fractionalization of shares that we keep talking about. So it's not just democratization, the compliance, the efficiency, and most importantly, self-sovereignty as well.
Yeah, some people keep insisting we wouldn't have an audit business. So we'll see how that plays out. Like, I think, so in this new world of doing things, as you said, in the real estate investing space, like, and if you think of this, there are certain entities who do a certain set of activities today in this market. Like, who has the most to gain and who has the most to lose in terms of getting disrupted? Any thoughts on that?
Well, I think, look, if you look at how we started with peer-to-peer lending, equity credit funding, and we moved to blockchain, and now we're here, security tokens. I mean, obviously, as one of the main gainers are the companies themselves that are doing it, right? When you have to, for example, just take a startup, right? That takes them 6 to 9 months to raise money or do a small round, and now they've deployed that capital, and they have another 2 years of runway, and then they have to do the same process. So you end up like half of your time as an entrepreneur, for example, raising money. But one aspect of tokenizing your company now, you do your initial raise, and now you want more money, you just sell your tokens on the market, you're getting like a faster access to capital. That's obviously one aspect of one of the gainers is obviously the companies. I wouldn't say tokenizing would disrupt VCs. I wouldn't say the VCs are losers on that front. I think we're starting to see kind of step up in the VC world where they'll need that innovation. I think I don't think there's really gainers and losers as long as you're adapting or not adapting. If you're adapting to that technology, you're obviously on the winning side. If you're not, you're going to be stuck behind. So that's why we're starting to see regulators being more open-minded. Okay, let's just start. You're starting to see, for example, audit agencies starting to look into blockchain, whether auditing security tokens or just blockchain projects in general. And for sure, for legal, that's creating a lot of creative world for them to see how their old world can match the new world. And that's one aspect of the whole gain versus lose balance we keep talking about is we're working with the regulations that are 50, 60 years ago old, and then we're trying to apply them to today's technology. So now, who's gaining, who's losing? Because as an entrepreneur, as a new company trying to innovate the space, am I gaining by implementing this, but I have a drawback of having to apply it to use the old rules? There's always that kind of perfect equilibrium that trying to find. If you're adopting a technology and keeping it up in mind, I think you'll be on the winner's side.
I also think that when you talk about not so much the losing side, but so much as the efficiencies we've talked about here, that there's a lot of back office requirements that probably will be reduced, and that's where you get those efficiency gains. I also think that it in any sort of loss where it could be attributed to fraud, again, I think that's one of those areas that I think blockchain can certainly make a difference on. So those are some of the advantages of what we've talked about here. And so I think that's a lot of value for organizations that are involved with this.
Yeah, and then I was going to just add that for MortageBlox, obviously the way we see the win is for a lot of these projects, and Kevin mentioned it in what he was talking about, there's more demand for funding than is being made available. So there's a lot of capacity in the Canadian market. We see in certain sectors, luxury, apartments, multi-unit dwellings across the country. A lot of those projects are just not being funded right now. So for the most part, it's not a disruption of an existing lender or an existing business. It's additive. So there'll be the availability of this capital that comes into these funds and is then able to be distributed will actually enable catch-up and projects to move forward that had been stalled in the past or weren't moving forward at all. So I think it's a lot of upside. Not sure exactly who gets hurt in that process.
Yes, I'm hearing a lot of upsides. I'm hearing a lot of positives. So what's going to convince corporate Canada to get on board? Because if you see these assets, there is only a few large exchanges who actually allow you to trade some of these. There are some futures in the US, CBOE, CBE, there are some options like that. What would cause, I'm hypothetically speaking, one of the large exchanges, NASDAQ, TMX here, to start thinking about listing some of this? What are the hurdles? Let's talk about the challenges a bit.
Look, if you're looking at a financial industry in general that's playing by the rules from ages, right? So there's a lot of middle layers of moving transactions. Just look public securities, like CompuShare, CDX, and the escrow agents, the custodians, the transfer agents. And now we're saying blockchain or tokenizing in projects are replacing a lot of those layers. But still, the institutional mindset is still used to that. So if I'm going to go to an institution, right, and say, hey, we're doing an IPO, but it's a token, they're going to ask for a custodian, they're going to ask for a transfer agent, but the smart contract itself is the transfer agent, right? So you're starting to see now companies emerge and saying, we're a transfer agent, but all they're doing is basically administering the smart contract on the blockchain. That mindset of, okay, well, these are the old rules, how do we apply them to technology that we have right now, is one of the barriers, in my opinion, that's kind of blocking this mass adoption by institutions. There is some experimentation, and some institutions are keeping more open mind than others, but they still ask for that. You have that chicken and an egg scenario, right, or chicken and egg problem. Institutions ask you for an escrow, or ask you for an underwriter, or ask you for a custodian, but yet there's not a lot of them on the market that can do that. And if they want to do that, they have to go to the regulators. And at the same time, the regulators have to understand the rules that you're playing with and how do you adapt it. So you have that endless cycle of who's trying to innovate and who's trying to follow. You're definitely starting to see the TSX, the CSC, NASDAQ, all of these guys are now launching initiatives to support tokenization or security tokens. Regulations coming into play is definitely helping. So you're seeing the SEC, you're seeing the OSC, AMF, the DCSC in Canada being active in the space. We have the Canadian Sandbox. All of these are kind of ways to meet in the middle, if you say, and kind of drive that institutional money forward. But still, until we figure out those middle layers and define them and what's replacing what, if any needed, if it's needed in the first place, that's when you're going to start seeing that institutional money flow deeper into the space.
And I think the other advantage of this technology is we have to look at this from a global perspective. So while we see some things here locally, I think that we'll start to see also, and we are seeing it, in emerging markets that didn't have the ability to access a lot of the capital that we're talking about here, and there are situations where more of need. So I think that's one of the other interesting things that we'll start to see over time, and we are.
Right. So I think you mentioned, both of you mentioned one point is corporate Canada needs trusted infrastructure to come up in this space. The custody is probably a most significant part of it, and till the Straight Street equivalents actually show up, it's going to be difficult to convince a large pension fund or a hedge fund to start moving their assets.
Yeah, because no pension fund wants to trust their wallet.
Right.
So I know someone in their IT department is hey, hold the wallet. There's billions of assets, right? So they want to have someone else hold it for them, and then they're probably having someone else hold it for them, another one. So there's that chain. But yeah, I get it. Look, institutions are not sophisticated with handling crypto or digital assets. They don't want to have the responsibility because it takes one person to lose the wallet or jeopardize the private key, and then all their assets are gone. And good luck explaining that to your investors and shareholders.
And the good thing is that the space is maturing. There's a lot of companies, institutions that are coming on board. For example, Fidelity just announced, they have a digital assets services. So I think it's happening.
All the big banks are starting to have RBC, National Bank, all these guys are starting to work on custodianship projects.
Yeah.
If I give you guys a crystal ball, and ask you to take a look and say how long would regulation and infrastructure need, what would be your guess?
It's definitely a 5
You
year
have a
plus.
crystal ball.
Well, I wish I had a crystal ball. I have that question with the regulators almost, like the regulators are pretty much on my speed dial. Like, my lawyers, my auditors, regulators, and then my girlfriend. Right? That's the order on my phone number. But I mean, look, just forget about blockchain for a second. We're still talking about equity crowdfunding and peer-to-peer regulations today. Like if there's still innovation in that space and how we can improve it, right? Reg A or like Reg A Plus, improving those models, limiting numbers. So even that space, which pretty much is 5-6 years old now, we're still seeing regulation updates on that front. So we're talking about a completely new space in digital assets. I think it's a 5-year plan. There's definitely hope, and I think regulations are starting, but we're really at that bottom of that belt, right? And people are coming in first. For example, Yash, ourselves, Plaza Corp. We're pretty much at the beginning of this. So we're the ones who kind of suffer. We're learning and teaching the regulators, and hopefully the others who come after will have learned from those case studies. But look, it's a learning curve, right? Originally in the financial world, you just go into the regulators, you explain the situation, and you file some paperwork, you're done because they know the process. Now you come in and say, well, look, it's an IPO, but it's a token, it's an exchange, it's not really an exchange. Like, well, stop. You have to explain everything, or everything works, how you're replacing every aspect. So it's not just about dealing with the regulators, it's also about educating the regulators, educating the institutions and the corporates. And that aspect takes long, right? When it's not vanilla and you walk in and walk out, that kind of adds more churn in your cycle. So for me, I think I'm trying to be optimistic here. I'd say a 5-year horizon. Other people might think differently.
So to your point, I think, have you seen anything happen in a structured manner, either in the US market where you have had a play, or in the Canadian market, to be more structured or educating regulators? Well, I'm thinking they are probably in the same place where they're trying to understand it, like manage their responsibilities and all of that. Like, have you seen any of these start to happen?
So I have to say that and when we talk about regulation, depending on, first off, the type of use case. So mortgage lending has got its own, or lending has its own regulators in the US. When we talk about tokens, the SEC has certainly, that wasn't up until last year where they really started to weigh in, and they continue to weigh in all through this year. And one of the things when we talked about around these ICOs and around these tokens, and because a lot of them, quite frankly, last year, majority of them, they didn't have very much behind their token offering in terms of an actual business, right? And so I think with the SEC stepping in and making their pronouncements about how they view tokens, and are actually subpoenaing, have sent subpoenas and letters out to companies, what it's doing, and quite frankly, is while yes, on some aspects we're being held up, I guess. But on the other side of things, I think you'd see that there are good projects that are out there that are being funded and are getting the attraction of these tokens, and hence companies like yours make a huge difference. And so, but again, it really depends. There's the whole thing around the tokens and how those securities go out into the marketplace, and then there's the actual regulation behind these various use cases. And again, what I mentioned earlier, you have to think about what that means from a global perspective as well, because even when we think about smart contracts, so you'd mentioned about trade finance as an example, and a lot of credit and bills of ladings, and so they have specific regulatory requirements. And now, if you have a smart contract in play, well, how does that play out? And the viewpoint will vary depending on the jurisdiction that you're in. And people and they're trying to a lot of people they're still trying to understand that. And to your patience and trying to educate, that's I think that there's lots of companies that are doing that, and I see that in the US as well, that there are companies going forward and spending time with the SEC, right? And so for them to see, and I think that there's a few projects that I have looked at, and the chairman of the SEC stood up and said there isn't a token that he's seen that's not a security. Well, in fact, there are projects out there that are using tokens that really are not, that are still pivotal to that particular platform. And these companies are going forward, and and it's not just the early stage company, but the corporate platforms that are behind it. One that Gary and I have seen, Gary Schwartz and I have seen, it's in around logistics, and this one particular company does a lot of work with Amazon. So, and they're very much in requirement of a token. So it's not cut and dry. We're still going to see a lot of. I think next year we're going to continually see some momentum and changes, but it is where it was a year ago. Very, very different ballgame.
I think to your point as well, Diana, mostly why the SEC is kind of ruling that everything is securities on that expectation of profit. So a lot of people are buying that token, although it's really instrumental for the use of the platform. You're still selling it on exchanges and making money out of it. And for them, that's what's defining it as a security. It's like the same way you go and buy 500 golf memberships for $10, and you sell them to friends and family and potentially people on the street for like $200. Would that be considered a security at that point, right? So that's one of the aspects of looking at it, the Howey test. But from a regulations point, I still think Canada is a bit more open-minded compared to the US, especially with the Canadian sandbox that we have here. We've heard about a lot of Regulate Plus in the US, for example. A lot of companies have applied for Regulate Plus, but we're yet to see one come out that survived the SEC and said, we have a Regulate Plus, right? So regulations are still pretty much up in the air. Some regulators are trying to learn on their own. Others are being educated. But we're hoping to see the lights.
Any questions from the room? Like, I think Gary's trying to catch up some time, so I'm going to accelerate this. Yes.
Yeah. How would blockchain benefit equipment finance?
Right. So the question was, I don't think the folks that got it, is how would blockchain benefit equipment finance? Like, anybody have a view?
I mean, I would consider it as a same way as a loan, right? So you're just probably more the equipment. I can see one way you can see it that instead of going to one source where you collateralize your investment or your assets, for example, or equipment to get from one person, one be the peer-to-peer over the net, right? So you can. I can see more companies kind of emerging and saying, okay, we'll take the equipment as a collateral and do the loan, and you'll source the money from crypto folks. That could be one aspect. If you want to have more of a kind of fractionalize the ownership of that equipment or that asset, that could be one approach. I mean, we're talking about people want to tokenize in the name, right? So how can you tokenize like a piece of art? So fractionalize ownership of that share. So that's what the fractionalization we're talking about is. It drives a huge advantage in that asset flow.
Yeah, I would say, like, I've heard folks tokenizing everything from real estate to carbon flows to like wood, luxury goods, art. So there's probably a tokenization model that can apply. And even if it's in the traditional sense, like, let's think about whether it makes it easier for the lenders to verify ownership, understand details about the project in a more trusted manner, so that you can have a more risk adjudications basis for providing that financing. I think like both approaches should possibly be relevant. Any other questions? Any hands? Okay, I have one to finish then, if you guys don't, is around adoption, right? Like we have talked a lot about this, seems to make a ton of sense, but nobody's really using these things at all, right? Like we haven't still seen the like normal Canadian human being start to get like introduced in a way that is meaningful. We have had speculation. Like we have not really had usage or adoption yet. And I know this is early, so it's possibly an early question. But what would have to happen in your minds, and Dana, maybe we start with you, is to get adoption? And let's not think that if you build, they will come. Like what would it need to happen to get them to come?
So when I think about this, and this question's asked a lot, and look, blockchain is a long-term play, and I think Gary had mentioned earlier about the fourth industrial revolution, and it is technology that's really very much a part of that. And to be frank, even if you were using blockchain, you probably wouldn't know that you're using blockchain. The thing with it today, and I'd say this is on three, and we've touched on some of this in the panel today, there's three aspects to think about, one of which is the technology itself. Blockchain, there's still a ways to go in terms of making that platform scalable. That's the one piece. The second piece is around regulatory, and again, we've touched on this. That's another aspect that companies are trying to iron out. And then the third thing I'd say to you from the business perspective, it's really about what makes this compelling. What is it that we're trying to do? What is it that you talk about the equipment finance, and there's a lot of different use cases for blockchain, but it has to be compelling for companies and individuals to want to get on board. And I think that once that happens, that will make a and again, this is a long-term play. Part of one of the things that I'm involved in is the Silicon Valley Blockchain Society. We have seen a ton of really good projects that are ongoing, and a lot of it is, again, global projects. But these are, and everybody talks about, these are long-term play. They're going to need a lot of financing involved, but the thing with the technology is that it's changing the way in which we think about business models, the way in which we collaborate, and the fact that it is global. So in terms of adoption, I think, what we looked at just a few years ago, where it was and where it is today, you'll see in 5 years from now, and again, we talked about the regulation, et cetera. I think that will make a big impact as well. So again, the thing that you got to remember is a lot of times you won't even know you're using blockchain.
Yeah, I think part of it is like keeping it simple, right? So if you talk to a lot of people who are new to blockchain, the first thing that goes into their head, oh, Bitcoin. Oh, but Bitcoin is very volatile, prices are dropped. So at that point, like they're already turned off by the whole thing. So it's like, there's the other aspect of blockchain, the technology side, where if it's embedded in your processes and it's basically completely transparent to the end user, that's when you're going to start seeing mass adoption. I don't need to know that a company using blockchain, my data is probably there somewhere, but I even need to know that, oh, I have to open a wallet, I have to do this. If the technology is being used in the background and being adopted by the consumers, that's when we're going to start seeing that mass adoption. Obviously, regulations coming into play is going to help more institutions pick it up, and that's going to drive more adoption from a financial user point of view. But until then, we need to kind of start building that differentiation between the actual cryptocurrency and the blockchain technology, because a lot of new folks see them as the one thing.
And it's first inning stuff, right? It's the very, very beginning. So I think people are looking for mass adoption of any of this at this stage it's just too early. So I think we've gone through this year the hysteria dropping down into disillusionment. Now we're into normalcy, I think, and I think it's going to play out very strong over the next five years.
Yeah, I think that's a very strong point of view. As we have been in the space for a while and we've seen this play out, it's good to see a real work happening and like innovators starting to push actual products out in market, testing this out. A few years back, it was a bunch of consultants writing decks, and that's not healthy. And I'm a consultant, career consultant, and I say this with a lot of respect to my colleagues. Is I think real innovation is happening, and one of the ways is to like make it real, try it, get involved in the space, and even if it's just putting a $20 downstairs in the Bitcoin ATM there, try it out. It doesn't hurt. It's $20, right? So like there is some of that hands-on thing that actually makes it real. Yeah, sure.
Just a final point is that also the building blocks are coming in place, right? Like there's companies like Polymath, which are Toronto-based, which are a platform where you can use to issue security tokens. There's companies like Pegasus who provide consulting services, and just getting engaged and learning more about it. Differentiating the different aspects of it, and just kind of engaging the community. I think will bring adoption.
Yeah, so I'm going to stop it before he just pulls me down. Thank you so much, everybody.